The power of dividend investing. Lessons from Warren Buffett and a roadmap for everyday investors. When Warren Buffett invested approximately $1.3 billion in Coca-Cola stock back in 1988, few could have predicted the staggering returns that would follow, not from selling shares or timing the market, but from simply holding and collecting dividends. Today, that investment generates over $700 million annually in dividends, equating to more than 50% of his initial outlay each year. This isn't just a story of a billionaire's success. It's a masterclass in the power of dividend investing, a strategy that prioritizes consistent income over speculative gains. For everyday investors, even those with modest means, this approach offers a viable path to financial freedom. With as little as $200 a month, you can build a retirement portfolio that delivers significant passive income. Let's dive into the mechanics of dividend investing, explore its historical context, and outline a practical strategy for long-term wealth. Historical context: the rise of dividend investing. Dividend investing has long been a cornerstone of wealth-building strategies, particularly for conservative investors seeking stability over volatility. Historically, dividends were the primary way shareholders received returns before the mid-20th century, when capital gains became a more dominant focus amid the rise of growth stocks. According to data from Yale economist Robert Shiller, dividends accounted for nearly 60% of total stock market returns from 1871 to 2000. Icons like Buffett have kept this tradition alive, favoring companies with strong fundamentals and consistent payout growth over speculative tech darlings or market fads. His Coca-Cola investment exemplifies the buy and hold forever philosophy, rooted in the belief that great businesses reward patient shareholders with compounding income. The global shift toward dividend-focused investing gained momentum post the 2008 financial crisis, as investors sought safer havens amid market turbulence. Central banks' low-interest rate policies further pushed income-seeking investors toward dividend stocks, as traditional fixed-income assets like bonds offered paltry yields. Today, with inflation concerns and geopolitical uncertainties, dividends remain a critical tool for hedging against volatility while building wealth over decades. Why dividend investing beats capital gains. Unlike the Hollywood trope of buy low, sell high, dividend investing flips the script. Instead of obsessing over market timing, a stressful and often unprofitable endeavor, it focuses on owning shares in companies that regularly share profits with shareholders. This creates a predictable cash flow, akin to a landlord collecting rent, without the need to liquidate assets. The psychological benefits are profound. Dividend income is tangible, hitting your account quarterly or annually, unlike paper gains that vanish in a downturn. Even during market crashes, strong companies often maintain or grow their dividends, offering resilience that growth-focused portfolios lack. Consider the emotional toll of capital gains investing. Market swings can trigger panic selling or greedy overbuying, leading to costly mistakes. Dividend investing, however, fosters a long-term mindset. When you're focused on income growth rather than price fluctuations, market dips become opportunities to reinvest dividends at lower prices, leveraging dollar-cost averaging. This strategy naturally aligns with human psychology, reducing stress and encouraging discipline over decades. The mechanics of compounding and dollar-cost averaging. Let's break down how dividend reinvestment builds wealth through a simple example. Imagine investing $1,000 in a stock priced at $20 with a 4% annual dividend yield, giving you 50 shares and $40 in dividends after year 1. Reinvesting that $40 when the stock dips to $16 buys you an additional 2.5 shares, more than you'd get at the original price. By year 3, after repeated reinvestment, your holdings grow to over 57 shares, a 14% increase without additional capital. This illustrates two powerful forces: compounding, dividends generating more dividends, and dollar-cost averaging, buying more shares at lower prices during dips. Historically, companies with strong dividend growth turbocharge this effect. Take UFP Industries, which has averaged over 20% annual dividend growth for the past decade. A $100 dividend today could become $120 next year and $144 the year after, snowballing your income without touching the principal. Unlike growth stocks, where gains are locked until sold, dividend stocks deliver value season after season, preserving your investment while providing cash flow. Building a dividend portfolio. Key criteria and picks. Not all dividend stocks are created equal. The goal isn't to chase the highest yield. a trap that often signals unsustainable payouts. But to find companies with consistent dividend growth, durability through economic cycles, and diversified exposure. Here are key criteria and a sample portfolio for a retirement-focused strategy. 1. Dividend growth over yield. Prioritize companies that raise payouts annually, signaling financial health and confidence. Visa, with a modest yield below 1%, boasts over 17% annual dividend growth, ensuring future income acceleration. 2. Durability. Seek businesses that survive recessions and maintain customer loyalty. UFP Industries, with its 20% plus dividend growth and steady share price appreciation, exemplifies this resilience. 3. Balance and diversification. Combine high-growth dividend stocks with stable, moderate-yield players across sectors. Goldman Sachs' 2% yield, 18% growth offers financial sector stability, while Morgan Stanley, 2.8% yield, 23% growth adds momentum. 4. ETF Foundation. Use dividend-focused ETFs like SCHD, Schwab U.S. Dividend Equity ETF, 3.93% yield, for broad exposure and reduced single-stock risk. 5. Long-term appreciation. Include stocks like Visa for capital growth alongside income, ensuring your portfolio isn't just an income machine but also appreciates over time. This sample portfolio, SCHD, Goldman Sachs, Morgan Stanley, UFP Industries, and Visa, averages a 2.14% yield, 18.12% dividend growth, and 13.64% share price appreciation. With $200 monthly investments, projections show a $2.06 million portfolio after 30 years, generating $129, $240 annually, or $10, $770 monthly in dividends, enough for a comfortable retirement without selling a share. Global and sectoral impacts. Dividend investing isn't just a personal strategy, it reflects broader economic trends. Globally, aging populations in developed markets like the US, Europe, and Japan are driving demand for income-generating assets, supporting dividend stock valuations. Sectors like financials, Goldman Sachs, Morgan Stanley, consumer staples, and industrials, UFP Industries, often lead in dividend reliability, benefiting from stable cash flows even during downturns. However, tech giants like Visa are increasingly joining the dividend club, blending growth with income as they mature. Yet, risks loom. Rising interest rates could pressure dividend stocks as bonds become more attractive. Sector-specific challenges like regulatory scrutiny in finance or supply chain disruptions in industrials could impact payouts. Diversification across geographies and industries mitigates these risks, ensuring your income stream isn't tied to one market or sector's fate. Trade-offs and mindset shifts. Dividend investing isn't without drawbacks. It lacks the thrill of overnight tech stock gains, and early dividends may feel trivial, just a few dollars monthly. Patience is non-negotiable. This strategy thrives over decades, not quarters. You're also forgoing the flexibility of quick cash-outs, committing to ride out market downturns. Discipline is key. Resist chasing higher yields or panic selling during corrections. Think of your portfolio as a garden. Tend it occasionally, but don't uproot it at every storm. Conclusion: investment implications and near-term catalysts. Dividend investing offers a compelling path to financial independence, trading short-term hype for long-term stability. For investors, the implications are clear. Start small, prioritize growth over yield, diversify, and reinvest relentlessly. A $200 monthly commitment can snowball into millions over 30 years, as shown by our portfolio projection. Policymakers should note the growing reliance on dividends for retirement income, advocating for tax policies that support dividend payers and protect shareholders from punitive measures. Near-term catalysts include upcoming earnings seasons, where dividend growth announcements from companies like Visa or UFP Industries could boost confidence. Central bank rate decisions will also play a role. Lower rates could drive more capital into dividend stocks, while hikes might temper enthusiasm. Finally, keep an eye on inflation data. Persistent price pressures could favor dividend payers as hedges against eroding purchasing power. For now, channel Buffett's patience. Pick your stocks, hold forever, and let time work its magic. Your retirement could depend on it.